Tribe, I want to show you how easy it is to build generational wealth. This is important, especially if you have dependents. I'm not only talking to parents because anybody can have dependents. So your dependents can be your parents, your siblings, your nephews and nieces. But for most people, your dependents are your children. So I want you to listen to this video.
And you should. And you should. And if you got any siblings, y'all should get together, pool y'all money, and get the biggest policy that y'all can possibly buy on your daddy. I don't know why this is so taboo to a lot of people to talk about, and especially people that look like me. Sweetie, I done already told my children, let's go and get $1 million policy on mommy and take the cost of it and split it. I'm gonna help them pay for it and split it between the three of us. It's just, it's just my 2 kids and me. And split the premium between us, and we'll just pay on it until mommy goes. That's $500,000 for you and your, for my son and my daughter when I do leave here. I'm 62 years old. Sweetie, if I get 20 more years, it'll be a blessing. Mm-hmm. If I live to see 80, it'll be a blessing. But what I do know is they ain't gonna save $500,000 in 20 more years. They're not, because they were having that. They're not going to save that kind of money in 20 years unless they get into some heavy investing. No, I've already told my children, it's time. It's time to get the biggest policy that you can possibly get on mommy, and we'll all pay it until I go. And that way they will have money to live off of after I'm gone. I tell them all the time, think of this as the last thing. Think of it as the last birthdays and Christmas presents and all those things that mommy do for y'all now. Think of that being the last thing that she'll be able to do for y'all. So, yeah, baby, don't be having an issue with doing it. And any parent that's out there, especially when they start getting over 60, they need to be starting to think about that. They need to have these conversations with their kids. They need to be sitting these children down and telling them financially how they gonna come up. Because they might as well profit off of our death. The people that don't look like us, the people that don't look like me, been doing this for years. Years!
So, first of all, the first time I came across this video, I was like, man, my God, I wonder how it feels like to have a parent, or like the kids, this woman's kids must be very lucky for them to have a parent who's that self-aware, right? Who's willing to have difficult conversations. Now, first of all, what is this lady talking about? She's talking about buying a whole life insurance policy. And so in this video, I want to break down what she's talking about. And I also want to tell you a story that inspired me this year, of 3 sisters that I helped buy whole life insurance policies. Each of them bought whole life insurance policies. And I want to tell you why you should come together with your siblings, even very good talking terms, and do the same. But first of all, before I explain, let me explain to you how a whole life insurance policy works. Why do we buy a whole life insurance policy? We buy a whole life insurance policy to protect our beneficiaries. Like I said, your beneficiaries can be your children, your nephews and nieces, your parents, your siblings, literally anyone who depends on your income for survival is your beneficiary. And so if you're a parent and you have children, your children depend on you fully. They depend on your income fully for survival. But then if you have siblings, parents, nephews and nieces, such people, if, for example, black tax is your thing, or you just want to support them, then they depend partially on your income for survival. So why do we buy a whole life insurance policy? We buy a whole life insurance policy to protect our beneficiaries. What are we protecting them from? We are protecting them from premature death. Let's talk about what happens in our Kenyan society. In a Kenyan society, when a parent dies, who is the main provider? Or even if it's not the main provider, as long as a parent was providing an income in a household. So it's either if one parent dies or if 2 parents die. What happens in Kenya or in a Kenyan society is that your kids, you're going to leave your kids with, maybe your sibling. And so your kids are going to be tossed from an uncle's house, an auntie's house, a grandmother's house. And a lot of us have experienced, or a lot of people have experienced this situation where, because you are being tossed from an uncle, a grandmother, a neighbor, sometimes even a friend, because you are being tossed from one home to another, you're going to end up accumulating a lot of trauma. And so your kids are going to end up accumulating a lot of trauma if you passed on prematurely and you left them without money. And so what happens in this case is that even if your sibling loves your children, let's say you say, even if I passed on prematurely, my sibling or my mother is going to bring up my children. Even if that relative loves your children, remember that that relative also has her own or their own financial responsibilities. So it can be in a situation where you have two children, your sibling has two children, and then you pass on. And so now what has just happened is that you have added two more children to that sibling's household. So even if that sibling deeply loves your children, that sibling will definitely say that as much as I love your children, and remember you're gone, as much as I love your children, I do not have the financial muscle, or I do not have the financial capability to bring up your children. And so in a lot of cases, or in a lot of situations, we've seen children ending up in children's homes. And so the question is that the trauma story you want for your child, or would you like to your child to end up in the same situation? And so that is why we buy a whole life insurance policy. You buy a whole life insurance policy so that you can protect your beneficiaries from premature death. Because if you buy a whole life insurance policy, it means that if you pass on prematurely, you will leave your beneficiaries X amount of millions so that their life can continue uninterrupted, at least prematurely. And so the way a whole life insurance policy works is that, for example, you buy a policy where you're paying, let's say, 10,000 shillings per month, and then you decide, and 10,000 shillings is an example, depending on your age, remember, depending on your age, you can get a policy with as little as 2,500 shillings, but allow me to use 10,000 shillings as an example. So you can buy a policy using 10,000 shillings, and you decide you're going to be paying for this whole life insurance policy for the next 15 years. Again, 15 years is just an example. There are people who pay for their whole life insurance policy for 10 years, for 15 years, for 20 years, up to the age of 65, up to the age of 60. There are different options. It depends on your age. And so you buy a policy where you're paying 10,000 shillings per month for the next 15 years. And let's say the insurer promises that if you passed on prematurely, they're going to pay your children 10 million shillings. And so what you're doing is that if, God forbid, you passed on next year, 2 years from now, 5 years from now, 7 years from now, your kids are going to be paid in lump sum. Because a whole life insurance policy does not pay you in installments, your kids are going to be paid in lump sum, the 10 million shillings. And so in this case, if, God forbid, you passed on prematurely, because the thing with us Africans, or the thing with that as Kenyans, we do not want to talk about death. And I know culturally, we are not comfortable having this difficult conversation. But the truth is, when it comes to passing on, it is a situation of when, not if, all of us are headed that direction. So if you have beneficiaries, it's important for you to get the courage, or for you to muster the courage to have this difficult conversation. So what was I saying? I was saying that you buy a policy for 10,000 shillings, pay for 15 years, and then the insurer promises that they're going to pay 10 million shillings to your beneficiary. So this means if you pass on 2 years from now, 5 years from now, 7 years from now, it doesn't matter. As long as you pass on before the 15 years are over, your beneficiaries are guaranteed that they're going to be paid the 10 million shillings. In fact, they are guaranteed that they're going to receive more than 10 million shillings, because the insurer also makes sure that they add on a bonus, for example, between 2 to 2.5% of the 10 million, they add on a bonus to that policy to cater for the rising cost of living or inflation. So literally, by buying a whole life insurance policy, if you have beneficiaries, it means you're buying your beneficiaries protection from premature death, so that you leave them X amount of millions if you passed on prematurely. Now, this lady, what she was talking about, she says that she's 62, she has 3 children, they've taken a $500,000 policy, is that it? Yeah, $500,000 policy, and she's even helping her children to pay for that policy, because eventually she's going to pass on. As she said, she's 62. If she's blessed with more than 20 years, it's literally going to be a miracle. And so now, let's backtrack to, let's say, the example that I was giving. Let's say it's a parent who has a 3-year-old child who bought that whole life insurance policy, the 10K one. If a parent has a 3-year-old child and they buy that policy that I was describing, between age 3, when that child is 3 years old, to the age of 18, and that is 15 years, right? To between the age of 3 to the age of 18, that's a span of 15 years, when this parent, which is exactly the term or the period of paying for that policy, is going to be running. So but that time, within the 15 years when the parent is going to be paying for that policy, what that parent would have bought is protection. You're protecting your child from premature death. Now, to connect it to that video of that lady, after 15 years, if you're blessed with a long life, right? Because a lot of us, yes, are going to be blessed with a long life. If you're blessed with a long life, what's going to happen is that after 15 years now, you stop paying for the cover, right? After 15 years. And then this child that I said, the 3-year-old, after 15 years, this child will be 18. So at that time, this specific parent can think of this insurance policy as a liquid inheritance to the child. And I always ask people, it doesn't matter whether you're in your 20s, whether in your 30s, whether in your 40s, 50s, it doesn't matter. If your parent left you 10 million shillings in cash, Kenyans, well, tribers, if your parent left you 10 million shillings in cash, wouldn't that change your life? Isn't that the difference between you deciding, oh, let me quit this toxic work environment and let me pursue my passion? Or let me quit this job and let me start a business. Let me quit this job, let me quit this hustle culture and, let me pursue the degree or whatever form of education that I wanted to pursue. So at first, the parent, within the 15 years of paying for the policy for this 3-year-old child, you are buying protection for your child. After the 15 years, because now this child is above the age of 18, what this parent was buying or what this parent bought now, this parent can think of this policy as a liquid inheritance. And first of all, before I continue, I want you to understand that for a whole life insurance policy, in order for your beneficiaries to be paid, you must have passed on. Yes, you must have passed on. So if you passed on prematurely, you bought protection. If you pass on in old age, you bought a liquid inheritance for your beneficiaries. Now, the reason why I brought up this video is that this video is saying that this lady, such a responsible mother, she's saying that white people, if I can say white people, Asians, because it's something that I've realized ever since I learned the importance of buying life insurance. White people, Asians, these people have been buying life insurance policy for years and years. It is just that us, maybe we didn't have access to the financial literacy, or also the fact that we are not willing to have the conversations around death. We are not willing to do the same. We are not willing to say, or at the same time, affordability, because, there are people who are in our communities who are still living, hand to mouth. People are still struggling to afford their basic needs, and therefore a lot of us cannot afford to have extra money to buy a whole life insurance policy. But for those of us who can afford to buy a whole life insurance policy, this is your sign. If this is your sign, especially if you have beneficiaries, to buy a whole life insurance policy. Because I always say, especially for parents, you are going to save and invest your whole life, and you're still not going to be in a position to leave the kind of inheritance money or the kind of payout that a whole life insurance policy does. It's the same way this lady was talking about. $500 million. She knows that her kids are going to hustle in the US, they're going to hustle, and they'll still not be able to get that kind of payout, or they're still not going to be able to have that kind of savings. So she came together with her kids and encouraged them to take a whole life insurance policy on her life, right, to get insured, so that when she is gone, not if, because all of us are headed that direction, when she is gone, her kids can receive $500,000. We're talking about $500,000, right? And so, Kenyans, well, tribers, I have told you that is the most important reason why you take a whole life insurance policy. You protect your young ones and then you leave them a liquid inheritance. Now, the key reason why I wanted to also have this conversation is, I said, a story of 3 sisters that I helped earlier this year. So I interacted with 3 sisters. All of them are married and all of them have children. All of them are moms, right? And so one day, when they learned of the concept of whole life insurance and what it does in terms of building generational wealth and also protecting their children, they sat down and started discussing, imagine 3 sisters, and they started talking about, if I passed on, imagine, let's say the first sister is called Mary. And so Mary was like, if I passed on, it means that I will leave the 2 of you with my children. You need to take care of them. And so they made a realization, these other 2 made a realization that, if you passed on prematurely, you would leave us to bring up with your children, to bring them up. And we love your children. We really love your children. But when we look at our households, we are already straining, or rather, we already cannot, the responsibilities that we have for our children or for our household, the budget is already strict enough. So if you add your children as Mary to our budget, it means that we are going to strain in as much as we love your children, we do not have the financial capacity to bring up your children, or rather we may not be able to maintain your children, Mary, when you're gone, at the same lifestyle or the same lifestyle that you had maintained your children. And so they thought about it and they're like, yeah, all of them decided that they are going to buy life insurance policies. So the three sisters, each of them bought a life insurance policy, so that if any of them, not just Mary, right, if any of them passes on prematurely, they will leave X amount of millions, so that these other sisters have the money, like literally have the money to bring up their children. And so each of them decided that if I passed on, so it's, if you're a parent, you can ask yourself, if I passed on prematurely, or even if I was blessed with a very long life, how much money would I leave to leave my children? Right? Or how much money would I want to leave the people, the guardians that are leaving my children? So you can decide, so that they can continue bringing up your children. So you can decide, is it 50 million? Is it 75 million? Is it 100 million? Is it 20 million? Is it even 5 million? Because we already know in our Kenyan society, there are so many kids whose parents die and they leave them with debt. They leave them with zero. They leave them with hospital bills. And so leaving your children 5 million is better than leaving your children with nothing. So this story of these sisters really inspired me. I was like, yeah, when I saw that video, I was like, yeah, as a family, as siblings, you have to sit down and ask yourself, how can we take advantage of whole life insurance so that we build generational wealth? Because I've always said, as parents or like as Kenyans, we are going to work so hard. We are going to hustle so hard for decades, and the amount of money we are going to have in savings or investments is still never going to match the amount of payout that you can get from a whole life insurance cover. Now, I like being practical. Let's say you're a parent, and I'm going to give, I can give several examples, and maybe I can even think about, the three sisters. So let's say one of the sisters is 40 years of age, right? Remember, insurance is a factor of age. The older you are, the more expensive it is to insure you. So I always say, as soon as you learn about the concept of whole life insurance, and as soon as you're able to afford to get yourself a whole life insurance, because if you get it when you're younger, it means that you're going to be able to get cheaper premiums. Premiums is the amount of money you contribute per month towards a whole life insurance policy. So yeah, you're going to be able to get cheaper premiums. So the younger you are, the cheaper it is to insure you. So let's talk about, one of the sisters who's 40 years old. So obviously gender is female. She's a non-smoker. I've talked about being a non-smoker because it is more expensive to insure a smoker than it is to insure a non-smoker. So one sister decided that she's going to be paying for the cover for 15 years. So she decided that if she passed on prematurely, to protect her children, she'd like to leave those children 20 million shillings. So how much does it cost this sister who's 40 years old in order for her to secure a 20 million protection in cash for her children? It costs her 14,785 shillings per month. So she needs to be paying monthly premiums or monthly contributions of 14,785 shillings per month for the next 15 years in order for her to be able to leave her children 20 million shillings. Now, usually when I have free discovery calls, because I usually have free discovery calls with wealth tribers who want to buy whole life insurance, one of the conclusions that people make when we do this calculation is like, so I'm supposed to pay the 14,785 for the next 15 years. That's what people say. So I'm supposed to pay 14,785 for the next 15 years in order for my children to be guaranteed to be paid 20 million. No. In as much as that sounds like a factual statement, it is not. Because what you're saying is that if you sign up for a whole life insurance cover today, and you're that 40-year-old person, remember this is just an example, and you're that 40-year-old parent, and then you start paying 14,785. You've signed up today, the 15th of June, when I'm recording this video. And let's say you pass on 6 months from now, your kids or your beneficiaries are going to be paid that 20 million shillings. Because think of it this way. If it required you to pay for this cover for the 15 years, like you must pay for the full 15 years in order for your beneficiaries to unlock the 20 million, then that would not be insurance, right? Like if you had to wait all the way for the 15 years in order for you to unlock the 20 million, then that would not be insurance, or rather that would not be protection. Because remember, the definition of a whole life insurance cover is that you're buying protection for your beneficiaries. So you're buying protection for if you pass on in year 2, if you pass on in year 7, in year 5, in year 10. So it means that you buy this cover today, and if you pass on 6 months from now, your kids or your beneficiaries are going to be paid the 20 million. So it doesn't matter whether you pass on, whether you pass on 2 years from now, 5 years from now, 7 years from now, your beneficiaries are going to be paid the 20 million shillings. So the frequently asked question usually when I have this discovery call is, what if I do not pass on within the 15 years, within that payment term or payment period for the whole life insurance cover? What happens? I always tell parents or people who are buying the cover, of course it's a nice thing if you do not pass on prematurely. Of course it's a nice thing if you're blessed with a long life, because then, like I said from the beginning, the cover, you start thinking of the cover as it stops being protection if the people you are buying the cover for were below the age of 18, and then it becomes a liquid inheritance. So yeah, if you're a parent, if you have beneficiaries, whole life insurance is something that you need in your portfolio, in your protection portfolio. One last thing, for you, in order for you to get why I said that we are going to hustle, we are going to save, we are going to invest in our whole lives, but we are still not going to be able to match the kind of payout we get from a whole life insurance cover. Let's do some simple math for this 40-year-old parent. So I said that this parent, in order for them to get a 20 million insurance cover for their children, they need to pay 14,785 shillings. So let's do 14,785 shillings multiplied by 12 in order for us to know how much will this parent be paying for this cover per year. And then we multiply by 15 in order for us to know how much will this parent pay for this cover for the 15 years if they're blessed with a long life. Because remember, if they pass on before the 15 years, the kids are going to be paid the 20 million. So if they're blessed with a long life and so they're able to complete the 15 years of paying for the cover, that math for 14,785 times 12 times 15 adds up to 2.6 million. So this parent or this insured person is going to pay 2.6 million over a period of 15 years in order for them to leave their beneficiaries 20 million. And remember, it is more than 20 million. Why? The cover earns 2.5%, 2 to 2.5% bonuses every year that this parent is alive. So if we do 2.5% multiplied by 20 billion to know how much bonuses this cover is going to be earning every year, that is 500k or 500,000. So if this specific parent is alive for the next 15 years, let's stick with 15 years as an example, we multiply that 500k of 500,000 multiplied by 15, that is an extra 7.5 million. So if they live a long life, the value of this policy will be, whole life insurance policy will be 20 million plus 7.5 million. So you paid 2.6 million to guarantee your beneficiaries of a liquid inheritance or a protection cover of 27.5 million. Look at how wild that return on investment is. And so with that, I do hope that you're going to start having these comfortable conversations with your siblings, with your family, with your parents. Another very frequently asked question from wealth tribers when it comes to getting whole life insurance cover. Can I get a whole life insurance cover for my 62-year-old mother, for my 75-year-old dad? The oldest you can get a whole life insurance cover in Kenya is 60 years old. So, and that is why it's very important for you to make important life decisions as soon as you get the financial literacy. So the oldest one can get a whole life insurance cover is 60. So if you're a parent or if you are above the age of 60, unfortunately, you can't get a whole life insurance cover. But if you're below, so a whole life insurance cover is for people between the age of 18 and the age of 60. And so yeah, let me know if you have other questions about a whole life insurance cover. And just for additional information, apart from buying it as protection and liquid inheritance for your children, you as the person who's going to be paying the monthly contributions, you can decide to add 2 more things to your whole life insurance cover, which is a critical illness cover. So you know the kinds of critical illnesses: cancer, kidney failure, coma, you need an organ transplant, you have a heart attack. So you know those kinds of critical illnesses. So you can add a critical illness cover. So let's say a 5 million critical illness cover to your whole life insurance cover, so that if God forbid you, the insured, ever gets diagnosed with a critical illness, you can get paid, for example, 5 million shillings, so that you're able to treat your critical illness, as opposed to what we do as Kenyans, where we create WhatsApp groups, get harambes, try to add people we haven't spoken to for the last 10 years, try to add them into these WhatsApp groups and try to get money to treat our critical illnesses. Something else that you can add to your whole life insurance policy to protect yourself is what we call an accidental death stroke disability cover. What is that? If any of us got involved in an accident, and accidents are many: car accident, boda accident. I was recently talking to a gentleman who's a mechanic, and he told me, for me, Agatha, anytime as a mechanic, a car or can fall on me, or a terrible machinery can cut off all my fingers, and that means I end up with a disability. And if I end up with a disability, that means I can't continue working. So an accidental death stroke disability cover, if you got involved in an accident and you end up with a disability, you get paid X amount of money. So let's say 5 million, if that is what you want, because you get to customize how much critical illness and accidental disability that you need. So yes, you get to customize how much you need. So if you get into an accident, get into a disability, you get paid X amount of millions, so that if you get to a disability, because that's a new lifestyle, to fund your new lifestyle. But if you get into an accident and die from the accident, it is your beneficiaries who are paid the accidental death money. In the case of an accidental death, your beneficiaries are paid twice: the accidental death money and the whole life insurance money. There are many other questions that I have received from Wealth Tribers about, whole life insurance, and I'm going to create an even bigger and better guide. But in the meantime, please let me know what you think about this conversation, and if you would like a free discovery call. If you're a parent, or if you are someone who has beneficiaries like me, I'm not a parent yet, but I did buy a whole life insurance cover at the beginning of this year, and currently my beneficiaries for my whole life insurance cover are my nephews and nieces. And yes, you can change your beneficiaries anytime. So if I get children, I can change my beneficiaries from my nephews and nieces to my children, or I can just add my children, right? Because maybe I still want to cover my nephews and nieces. So your beneficiaries can be changed anytime. So if you'd like to have a free discovery call, if this is something you feel that you need, and most of us do, if this is something that you feel that you need, just send me an email at agatha@thewealthtribe.com and say, I need a free life insurance discovery call. I will respond, and then we will set up a free discovery call, and we will have a conversation about how to make sure you're protected from accidental disability, critical illness, and also to make sure you protect the people who depend on your income. And if you're blessed with a long life, why don't you leave them $500,000 in inheritance if you can afford to? Let us put a stop to the hustle culture if we have the resources to put a stop to it. And with that, see you soon.